Welcome back to Audit ABCs with Jess. Today, we're starting right at the very top of your audit or review file with one of the most important documents you'll ever complete, the Engagement, Acceptance and Continuance working paper. This working paper answers one simple but critical question. Should we take this client on, or should we walk away? And believe me, making the right decision here can save you from months of frustration, stress, and even legal trouble.
The Engagement Acceptance working paper isn't just paperwork. It's a risk filter, a gatekeeper. It forces you to stop and think before diving into an engagement about ethics and independence, management's integrity, whether the job is worth the effort and the risk, and whether you even can do the work. If you're not confident on any of those, the answer might need to be no.
All right, so today I'm going to show you how to complete the Engagement Acceptance and Continuation working paper, what you need to look at, and how to document it properly. In auditing, documentation is everything. The purpose of this working paper is simple. It's your record of what you considered and why you made your decision. That means you still need to fill in this column with your considerations and the work you've done. For this demo, I'm using the Draftworx working paper. I use Draftworx for both financial statements and audit working papers, so I know it well. Even if you're using different software, the questions and purpose are basically the same. Finding the working paper. In Draftworx, open your client, go to Working Papers, then Engagement and Team Setup. This is the first part of the planning phase. You will see that there are a lot of working papers in this section, but today we're focusing on Engagement Acceptance. From here, you'll see the rest of the planning papers, the execution papers, and finally, the finalization papers. We'll go through each of them in the next videos that will follow, so make sure you subscribe so that you do not miss them. So, when you open this working paper, you will see the client name pulls through automatically, the heading of the working paper, and the reporting date. When you click Prepare, today's date appears and your initials are added automatically. Upon review by the manager and partner, the respective review dates and their initials will appear once they sign off. There's a comments box. Use this for any notes for your reviewer. These fields are crucial for every working paper. Okay. So, the working paper lists 22 procedures you need to consider. After all considerations have been made, at the bottom, there's a drop-down where the partner will conclude to either accept or decline the engagement. You will see the drop-down that provides the following two options. Based on the above assessment, I am willing to continue with the review engagement, or I'm not willing to continue. Then you click Accept or Decline. If you accept, all other working papers open up. If you decline, some will remain locked. Complete the working paper as follows. Procedure. This is the factors you are going to consider. Response. Usually a drop-down stating only yes or no to indicate your conclusion for that procedure clearly. Initials. Here you sign off on your answer by clicking the Initials tab on the right. Record of work done. In this column, you explain your reasoning and what work you did. Sometimes there will be references to other working papers which will help you with your consideration, which will comprise your record of work done. If there isn't one, you need to clearly document your work done here. For example, yes, based on reviewing the client's compliance history and verifying their tax registrations, no noncompliance was identified. When your manager or partner reviews, they'll check your work to see if it supports your yes or no answer. So your documentation is very important. They need to see what you saw because at the end, the partner decides whether to accept or decline the engagement based on all the work done. This decision is crucial. It can save you from major problems, unnecessary costs, and risks down the line. Now, let's go through each procedure so you understand what it's for, what to consider, and the risks involved. I'll point out where the linked working papers are, but I won't open them here. Each one will get its own video.
1. New or continuing engagement. If it's a new engagement, you need extra due diligence. That might include researching the company online, checking CIPC records, contacting the predecessor practitioner to hear about any concerns, and even running basic background checks on key directors. If it's continuing, don't assume all is well. Example, you've worked with ABC Trading for 5 years, but this year, they've brought in a new CEO who previously ran a business into bankruptcy. That changes the risk profile completely. 2. Quality management, ISQM 1. Every firm has policies about which clients they will and won't accept. Some avoid high-risk industries like mining or gambling. Some refuse engagements where the business is linked to politically exposed persons. Example, even if you personally are comfortable working with a cannabis supplier, your firm's risk policy might prohibit it because of anti-money laundering concerns. If accepting the client would contradict firm policy, you have to decline.
3 and 4. Rational purpose and suitability of review engagement. A rational purpose means there's a valid reason for the engagement. For example, a bank requiring a review before approving a loan. That's valid. But let's say a small business owner asks for a review to make the books look more official without planning to give you all the records. That's not a rational purpose, and it's a big warning sign. Also, is a review even suitable? If the company is highly complex, say a multinational with multiple subsidiaries, a review might not provide enough assurance. In that case, they might actually need a full audit. 5. Ethical requirements and independence. Independence is both actual and perceived. Even if you think you can remain objective, how will it look to an outsider? For example, if you own shares in the client's company, that's an obvious breach. But even something like your sibling being the financial manager could create a perception problem. If the threat can be reduced, maybe by assigning a different engagement partner, that's fine, as long as it's documented. If not, you must decline. Ask yourself, will they give me what I need when I need it? For example, last year, another reviewer may have complained that they only got the trial balance a week before the report deadline. That delay can affect your ability to do a quality job. If you already know the client won't give you access to critical records, it's better to decline now than to fight about it later. 7. Management integrity. You need to be able to trust what management tells you. If you've seen them mislead regulators, avoid paying taxes, or give inconsistent answers, that's a serious red flag. For example, if management says one thing in meetings, but their emails tell a different story, you have an integrity problem. Without trust, you'll constantly be questioning the reliability of the evidence. 8. Limitations on scope. If the client says, you can review sales but not expenses, that's a limitation on scope and you may not be able to form a conclusion. For example, a construction company might refuse to show you details of certain contracts. If those contracts are material, your report will be incomplete.
9. Predecessor practitioner. If there was a previous reviewer or auditor, you should ask why they left. For example, if they resigned due to unpaid fees, that's a warning you might face the same issue. If they resigned because management wouldn't provide records, expect the same behavior. 10 and 11. Firm and team independence. You might be independent at firm level, but what about your team? For example, a junior team member could be dating the client's accountant. That's a clear conflict. Or someone might have previously worked for the client and still have strong loyalties. Every team member must declare independence before starting. See the links to the specific working papers for this? Remember to subscribe so that you don't miss our next detailed discussion of this working paper.
12 to 14. Financial Reporting Framework. This is about what set of rules the financials will be prepared under. Example, a small, family-owned retailer may prepare under IFRS for SMEs. A nonprofit might use a special purpose framework designed for grant reporting. If the framework is inappropriate for the intended users, that's a problem you must raise immediately. 15. Firm competence.
Even if you want the job, ask, do we have the right skills and capacity? Example, if you've never reviewed a company with cryptocurrency transactions, you might need an external expert. If your staff are already overloaded, taking on this client could compromise quality across all engagements.
16. Preconditions, management's responsibilities. This is a non-negotiable area. Management must prepare the financials, maintain internal controls, provide all relevant information, and allow unrestricted access to staff. Example, if they refuse to give you payroll data, that's a deal breaker.
17. Signed engagement letter. Never start without it. It defines the scope, timing, and responsibilities. Example, if you verbally agree to a review, but the client later insists they thought it was a full audit, a signed engagement letter protects you. 18. EQR requirement. Some jobs need a second reviewer, an engagement quality reviewer, before the report can be signed. For example, high-profile companies or engagements with significant public interest often require EQR under ISQM1.
1920. Companies Act and Public Interest Score. In South Africa, the Public Interest Score determines whether a review or audit is required. Example, a company with a PIS over 350 might need an audit. If you calculate it incorrectly, you could be doing the wrong type of engagement. 21. Can the client pay? A client who can't pay now will likely delay or avoid payment later. Example, startups often have cash flow issues. They may agree to your fee, but struggle to meet deadlines. 22. Legal requirements. If the law says the client must have a review, you must document the specific regulation. Example, some cooperatives and public benefit organizations are legally required to submit reviewed or audited financials annually.
So, what's the real goal of this working paper? To protect you, your firm, and the quality of your work. Ultimately, it's your professional judgment whether to accept or continue with a client, even if they've had issues in the past. If you've identified the risks, documented them, and can meet all ethical, independence, and legal requirements, you can say yes. But if independence is compromised, preconditions aren't met, or laws prohibit it, you must say no. That's the balance between professional discretion and compliance with the standards. Don't forget to like, subscribe, and share in the comments if you've ever had to walk away from a client at this stage. Next time, we'll unpack independence and ethics. I'll see you there, stay safe, and keep auditing easy.